So let's get rolling on this topic. We're gonna cover S corporations, and this is a basics overview. So really, this is about a 3-hour overview of all of the topics that are pertinent to S corporations. And so we're going to start out with some of our objectives, which are to explore the definitional concepts of S corporations and S-Corp tax generally. So there are a lot of definitions in S-Corps. It's similar to when you go from a corporation to an LLC or from an individual to a corporation. A lot of things that are similar just have different names, but they're basically the same thing as what you've already seen. So we'll go through some of the definitional concepts for S corporations. And then we want to consider the requirements for filing and maintaining an S election. And this is actually probably the biggest unique part of S corporations, is that you have these S elections which have to be maintained. And we'll talk about what that means and why that's important in a bit. And then we want to introduce concepts regarding how S-Corp tax differs from the taxation of corporations and the taxation of partnerships. So if you have some familiarity with other flow-through entities like partnerships, then you'll understand certain aspects of S-Corps, and that's why it's easy to go through them quickly, because most people have some understanding of flow-through entities. And then corporations as well. A lot of you will be more familiar with corporations. You've already seen them and maybe studied them, or you're familiar with them. And so when you're learning S-Corps, it's more or less, apart from the S election segments, which are specific to S-Corps, a lot of the other aspects are really just looking at items and saying, okay, this functions like a partnership, and other items, this functions like a corporation. That's pretty much it. So we're gonna go through. So let's take a look at the S-Corp tax generally. This is just, again, overview. So S corporations are qualifying corporations that file an S election. So legally, what we're talking about here typically are corporations, C corporations, and not always because of the check the box regs, which I'll talk about in a minute. But generally speaking, what you're doing is taking a regular corporation and filing an S election. And so for purposes of the Internal Revenue Service, they're just seeing a corporation that files an S election. That's what a corporation is. It's really a tax concept. There isn't such a thing as an S corporation under state law. You don't file articles of S incorporation. You just file your regular articles of incorporation, and then this S status is a tax concept. And you got to think about it similar to with partnerships, where LLCs, general partnerships, those are all taxed as partnerships under the same rubric. Well, these, for state purposes, S corporations are just corporations. That's all they are. Now, there are some wrinkles with that because of the check the box regs, which I think we've discussed before. But if you look at the check the box regulations, that essentially permits any partnership to elect to be taxed as a corporation. And so any C corporation under the tax law can then file an S election, as long as they meet the rules that we'll go through in a bit, and become an S corporation. So technically, if you're looking at the state law, the default would be corporations are taxed as corporations and then can file S elections and be S corps. But LLCs and partnerships and limited partnerships under the check the box regs can check the box to be taxed as a corp and then file an S election. So you actually, in terms of what the state law entity it is, it really could be any state law entity that's an S corporation. It's just that for tax purposes, they file an S election. So S corporations are taxed in some ways like tax partnerships, and in other ways like C corporations. So they have elements of both. And it's mostly important to understand how they differ from those. And if you already know a thing or two about partnerships and a thing or two about corporations, you just need to know which ones act which way, and you can understand S-Corps fairly easily. So S corporations follow the corporate rules, and this isn't a comprehensive list, but these are the main things that are pertinent. That they follow the corporate rules for initial contributions. So that would be following IRC Section 351. And initial contributions, you'll note that this is different from partnerships, because initial contributions in partnerships don't have to have the 80% control rule. You may be familiar with that. But in corporations, you do. And so what that means is when you're contributing property where the basis is different from the fair market value, if you contribute that to a corporation, you get a non-recognition event so long as you control the corporation after your contributions are made. So under 351, the corporate rules are going to govern for S-Corps when you're making contributions to S-Corps. So that's an important concept, is that it's going to affect organizations of corporations. And if you have some concerns about whether you're going to have control after contributions are made, or if you're going to have some contributions now and then some a little bit into the future, then you may consider filing as a partnership initially, and then making your check the box reg election to be taxed as a corporation, then file your S election after. So you really want to do these after everything's already been organized. The second thing is distributions of appreciated property have recognition events under S corporations. Under partnerships, if you have property that goes up and down in value, you can actually contribute it to a partnership and distribute it from a partnership without recognizing any gain. Now, there are some limitations like mixing both transactions and hot assets that are prevented, that prevent you from doing that. But as long as you don't violate those rules in a partnership, you can transfer property in and out, and you aren't necessarily recognizing gain at any point. That's not so with S corporations. If you transfer a property into an S corporation and it appreciates over time, or even if the value holds steady but you depreciate it down, so your basis goes down, so there's a gap between your basis and the fair market value. Anytime that happens with an S corp and then you transfer it out of the S corp, you're going to have to recognize gain. So the main thing is you don't want to have assets that are likely to generate gains held in S corporations. So for instance, depreciable assets that you might stick in an S corporation, it would make sense to put those in if they do in fact waste. So some assets like vehicles, for instance, you put that in an S corporation, makes sense because the vehicle, while it's depreciating, the fair market value is going down because vehicles tend to depreciate in value quite quickly. They tend to waste. Contrary to that, though, if you look at like property, for instance, like real property, you have a building that depreciates slowly over 39 years, but oftentimes the value actually goes up that entire time. And so buildings aren't typically things you'd want to put in a C corporation or an S corporation because they tend to appreciate, and you depreciate them as well. So you get it kind of coming and going, you get hit with gains. And so that's a problem when you're trying to transfer these assets out of the entities. Also, any issues not specifically dealt with in subchapter S are then going to follow the C corporation rules. So subchapter S is going to tell you basically all the ways that S corporations are different from C corporations. So since these two issues aren't specifically dealt with in subchapter S, or they reference the C corporation rules, these are the two big things that tend to be different between partnerships and S corps. But there are other things as well. So for purposes of the taxation of ongoing operations, S corps are taxed like tax partnerships by filing a separate tax return, but they generally pay no tax because they're a flow-through entity. And one of the things, this is where they're very similar to partnerships. So for purposes of ongoing operations, they function a lot like a partnership as a flow-through entity. You have separately stated items, so different types of items, gains, you have capital gains and loss, which function in a flow-through manner. So even though if you distribute property out and you have to recognize those gains, there is still a difference between S corporations and C corporations because in the instance of the building, it might be a capital asset, and so you might get capital gains on it. So you do have capital gains, that rubric within S corporations. So you do get that type of treatment, which is good. You have Schedule K and Schedule K1s when you file the tax return for an S corporation, very similar to a partnership. You're basically going to designate what your separately stated items are, and you'll include that in your Schedule K and K1. And so really for operational purposes, S corporations function a lot like partnerships. There are ways that they're different, though. Something else may come into play, and that's earnings and profits. So earnings and profits is a corporate concept, and essentially it has a bunch of consequences within the corporate realm. And some of the common effects of earnings and profits in a C corporation are that when you make distributions to shareholders, if it's out of your earnings and profits, that distribution is deemed to be a dividend. If your distribution exceeds your earnings and profits, the distribution is treated as a return of capital, and there's a bunch of other ways that earnings and profits come into play. So there's special calculations for E&P that we're not going to go into now. But the main issue is if you're a C corporation for a while before you file your S election and you have earnings and profits, then that has tax significance within the S corporation. Now, remember, S corporations aren't double taxation, so they don't have necessarily the same rules in terms of money you distribute. They function more like a partnership in that concept, in that instance. But when you have earnings and profits that's carried over from when it was a C corporation, there are tax consequences, and so it comes into play if the corp was a C corp for a while and had earnings and profits at the time it made its S election. So there are some wrinkles there, and that have some interesting tax consequences. We aren't really going to spend a tremendous amount of time going into those. It's just that you do need to note that if you're dealing with an S corporation, you always need to know if there were earnings and profits in the entity before the entity made its S election, and then you'll need to look at the regs and see how to treat those. Concept number 3, big picture concept, is what we call blowing an S election. I didn't come up with that vernacular. That's just the way what it's called. When you blow the S election, it means you fail to meet the requirements of the S election. If you have an S corporation that fails to meet the qualifications to be an S corporation after the fact, it loses its S election, and then it defaults back to a C corporation. Now, you can imagine that there are a lot of negative tax results that can occur as a result of blowing the S election. For instance, you no longer have the differentiation between capital gains and ordinary income. Everything's going to be treated as ordinary income. You've now gone from being a flow-through entity to being a double taxed entity, which is also a problem. And so there are a bunch of bad things that happen when you mess up your S election. Now, that being the case, it's actually quite surprising how easy it is to mess this up. And this happens all the time. And really, the critical area, if you're in practice where you need to watch out for purposes of blowing an S election, is if you have attrition, like a small business that's held as an S corporation, and the person's getting close to retirement or has already retired, and the shareholders are likely to die and then pass the shares on to their beneficiaries or to various places where they may give their money away. That is the biggest problem in terms of potentially blowing S elections. And we'll see why when we go through the rules. But you can see how that would be. There are a lot of negative tax consequences that can result from that. So you don't want to blow your S election. You have to make sure that doesn't happen. And you also typically will have an operating agreement or bylaws or some kind of agreement among the shareholders, such as a shareholders agreement, that permits the company to buy back shares whenever anybody distributes those shares in a way that would blow the S election. And so that's an important provision, is that you have a shareholder agreement anytime you have an S corporation. And that's a legal document that the lawyers will draft up, but it's just important to know that those are necessary. Partnership taxation versus S-Corp tax, we're going to look at some of the pros and cons. The differences between these entities are going to be highlighted throughout the course today. And so, but we'll go through really quick and highlight some of the specific things that are different. So S corporations lack the flexibility in allocating items of income, loss, and deductions that are afforded by LLCs. So partnership tax, you can do special allocations, and that means that you'll be able to allocate income, loss, and deductions and depreciation differently for different partners. That's not the case in S corporations. S corporations, everything is basically pro rata. And so if you're a shareholder, whatever percentage shareholder you are, you're going to get that percentage of the company's tax items. So if you own 20% of the S corporation, you will get 20% of the income, 20% of the loss, 20% of the capital gains and losses, and 20% of all the deductions and credits. It's going to be just pro rata. It's much simpler in terms of determining who gets what. And so you lack the flexibility to make special allocations. S status imposes several restrictions on the number and type of owners the entity may have. We'll go a lot more into depth on that. But LLCs really have no restrictions on the types of owners. And so I say LLCs, but really what I'm talking about is tax partnerships, because LLCs tend to be the favored form of tax partnerships. But a tax partnership doesn't have any restrictions on the type of owners. They can have any type of owner, really, and that will be fine. S corporations have limitations on who can hold S corporation stock. Then many transactions that escape current taxation under subchapter K, such as distribution of appreciated property, are taxable to an S corporation. There's also additional taxable consequences if the S corporation has E&P, as we discussed before, carried over from a C corporate status. Then the aggregate ordinary income allocated to shareholders of an S corporation, even those who are actively involved in the management of the corporation, are not subject to payroll or self-employment tax. So this is actually one of the tax benefits of being an S corporation. Partnerships, typically, any active member of a partnership, other than a limited partner, is going to have to pay payroll taxes on the full amount of their income from that partnership. Now, there's some gray area there. There was a proposed reg once upon a time that never was made final that permits partners who aren't active in the business to avoid payroll taxes. But the IRS is actually still going after people who adopt that approach. It's kind of a gray area. We'll see what the case law does over time. But it's very clear that S corporations, owning shares in an S corporation and receiving your distributive share of income from it, will not subject you to payroll or self-employment tax. There's a special rule, and we'll talk about how that works in a bit. Subchapter S contains no provision analogous to Section 751 that will recharacterize a gain on the sale of corporate stock as ordinary due to the nature of the assets held by the corporation. So that's another distinction. Self-employment tax rules follow the corporate model, and that provides for tax planning opportunities. This is a much bigger deal now than it was even 5 or 10 years ago, because the Affordable Care Act implemented additional taxes. You have the additional Medicare tax. You also have the net investment income tax. And there are certain planning opportunities where you can avoid both taxes by utilizing an S corporation. And it's not an aggressive planning opportunity. It's just the basic laws suggest that you aren't subject to payroll tax in certain instances. So there are additional planning opportunities there. And then changing from an S corporation to an LLC will require liquidation of the S corporation, triggering recognition of any gain related to any appreciated assets. Okay, so once again, S corporation and LLC, it requires the liquidation of the S corporation. So it's similar to transferring all the assets out of the S corp into a new partnership. That's really under the law how it's treated. So if you have a whole bunch of appreciated assets, you don't want to go that direction. It's going to result in a lot of gains. And I actually had a major client who did this, and that was within their prerogative to do so, but they did have to have a year where they took a pretty big bath on recognizing a bunch of gains. But they felt like long-term it was worth it. So, all right, so now those are kind of the tax consequences that you're going to see. We want to look at qualifying for S corporation status now. And what are the requirements for doing so? Really, what we care about for purposes of qualifying as an S corporation is the shareholders. We're going to look at what the shareholder makeup is. And as long as the shareholders at the time of the S election meet this requirement, then you can be an S corporation. Of course, if you fail to meet the requirement at any point in the future, you then lose your S election. So the entity must be a domestic corporation. So this is at the entity level. Foreign corporations can't file S elections and be S corps. The entity must be an eligible corporation. There are certain types of corporations that are ineligible, like insurance companies, and I believe publicly traded companies can't be S corps. There may be other restrictions, but those are just the two that I'm aware of. The entity must have only one class of stock. So this means you can't have common stock and preferred shares. You have to have only one class. And so that's a requirement. Now, there is some wiggle room within that requirement. If you read the statute carefully, you can see that it's not as cut and dry as that. But basically, in most cases, you need to have just one class. The number of shareholders cannot exceed 100 after the family rules are applied. So only 100 shareholders. So the idea behind an S-Corp is that it'll be a small corporation. That's really where the S comes from. That's the idea. But when we're talking about it being a small corporation, this is what we mean by small. 100 or fewer shareholders. It doesn't have anything to do with the profits of the corporation. It doesn't have anything to do with the assets within the corporation. It really only relates to the shareholders. You all right there? Good. All right. So the number of shareholders, like I said, can't exceed 100 after the family attribution rules. But the family attribution rules are really liberal. And what I mean by that is basically shares held within a family among spouses and children and such are very liberally considered to be held by one taxpayer. And so that helps for purposes of keeping things under the 100 shareholder rule. But if you violate that rule, you've blown the S election and you no longer are an S-Corp. Shareholders may only include, and this is important, individuals, estates, certain kinds of trusts, and there are some limitations on that we'll talk about, and exempt organizations. So that's it. That's your list. So what don't you see on here? Anything missing from this in terms of who can be a shareholder, types of shareholders?
Partnerships, other corporations, businesses.
Right. So you don't see any partnerships in the list, and you don't see any corporations in the list. And this isn't totally comprehensive. You actually can have an S corporation that holds S corporate stock in certain instances. We'll talk about what that is. But yeah, no partnerships, no corporations. So S-Corps basically need to be held by individuals. An estate is really just after an individual dies, so that's really an individual. Certain kinds of trusts that are limited in exempt organizations. And that's it. That's the only types, the only shareholders that can hold S-Corp shares. Shareholders may not include non-residents. So if you have somebody your shareholders need to be U.S. citizens and resident aliens, so non-citizens who are U.S. residents. In other words, if you're a shareholder, you need to be paying tax in the U.S. That's really what they're getting at with this particular requirement. So if you're outside the U.S. and you're not a citizen and you hold S corporation stock, that blows the S election. And then 7, a timely S election must be filed. So you have a certain amount of time to file the S election, and it needs to be done within the time prescribed under law. And then 8, no maximum revenue or capitalization restrictions. So the entity doesn't actually have to be small. I mentioned that before. You can have billions of dollars in an S corporation. That's fine. So it's not about being a small company. Really, when you hear small, what you should be thinking is closely held. It needs to be held by a small group of people. But that's the only thing that needs to be small about it. Yeah, question?
So there doesn't need to be like a max amount of employees?
No. So the number of employees has no bearing on whether it's a small company. It's really just the number of shareholders that we care about. Yep. Or for purposes of S corporation rules. In fact, one of the corporations that I worked on from practice, they had tens of thousands of employees. It was a huge restaurant chain, and they were an S corporation. And they had, they actually had a status where they kept all their land holdings in an LLC, and then they kept their business operations in an S-Corp, and that's how they ran the business. And, they had tens of thousands of employees. It was huge. It's a chain you'd recognize, although I don't know that I'm at liberty to say because of client requirements, but you would recognize the restaurant if I told you who they were. It's large. No. I'm going to keep that close to the vest, I guess. All right, let's look at a problem. We want to look at the first problem here. So we've got a group of owners are seeking to form a special sandboxes company, or S, which is an awesome name for a company. A company that manufactures sandboxes to be sold both domestically and internationally. The owners are considering organizing the business as an S corporation. Please determine based on the following facts where the company would be eligible to file an S election and or whether any of the subsequent facts disqualify the entity for being an S corporation. So I'm going to give you a whole, there's a whole series of facts in this problem. So we're going to look through them and just say, okay, are we good as an S corporation? So part A is it's all in the family. Assume S is a domestic company with the following shareholders. Consider each fact independently unless otherwise stated. So basically, think of these as additional facts that are independent from one another. So the first one is S has 101 shareholders, all U.S. citizens, and 2 of the shareholders are husband and wife who own their shares in their individual names. So what's the shareholder limit? 100. So we're over the shareholder limit. So on the surface, you would say, oh, this doesn't qualify as an S corporation. But the additional facts, and this gets into the family attribution rules, and we'll talk about those right now, actually, is that you have a husband and wife who are holding the shares. So under the regs section 26 CFR 1.1361-1E2, that's a mouthful, this could qualify as an S corporation because husband and wife are deemed to be the same shareholder under the family attribution rules. So we're okay here, just barely. Now I'm not sure if it's wise as a matter of practice to be starting an S corporation where you're already at 100 shareholders because like you're really close to the line, but there it is. So there's that. By the way, the 100 shareholders, in the past, it used to be 75, and for whatever reason, they bumped it up to 100. They're also, the family attribution rules weren't as generous once upon a time. They've kind of expanded those over time because as these corporations got older and people had kids and gave their shares to their children, they felt like these were just arbitrary, and so people lobbied to get the shareholder number higher and were successful. Now 2, what if instead S has 102 shareholders, 3 of whom are a mother, her son-in-law, and her grandchild? So now the question is, how far do the family attribution rules go? And so the mother and her grandchild are one shareholder, and the son-in-law is also a member of the family by virtue of being a spouse of a descendant. So this actually brings all 3 of these people in as one shareholder. So just repeating that, the family attribution rules, it brings in the grandmother and all of the grandmother's descendants plus spouses of the descendants. And so in this case, grandmother, granddaughter, and son-in-law are all considered to be one shareholder for purposes of this. Yeah, good question.
Okay. It's bringing it to our other tax files?
Yeah, sure.
Taxation too.
That's okay.
Barilla said that son-in-laws, daughter-in-laws, they can't transition to the grandmother because they have to go through their spouse. And like their spouse owns their grandparent.
Right. So you're noting that this rule is different from the C corporation rules from 311. So the C corporation rules are a little bit different for in-laws. They may not count. This is a S corporation specific reg. And so for this one, it brings in all spouses and it brings in all descendants. So this one, you actually do get the son-in-law in. So the son-in-law is a spouse by virtue of being or the son-in-law is included by virtue of being a spouse of a descendant because you've got the 2 rules working together. Now, other family attribution rules in C corporations, for instance, may not work this way, and I think that's where the confusion comes in here. But this is a specific reg for S corporations, and it's specific to them. So we're following that reg, so it is a little bit different. Same facts as one above, except H dies, and his shares are held by his estate. So does this change our answer now that you have an estate that's holding H's shares? We're going back to 1. Now, the facts of 1 is 101 shareholders, husband and wife. So husband has now died. So now instead of husband and wife, you have husband's estate and wife. And the question is, what does this do to our S election? Do we blow it in this case? And the answer in this case is no, because an estate is basically deemed to be the same as the person who died. And so in that instance, you're okay. So the estate's still going to be fine. So same facts as 3 above, the one we just did. except now we're looking 2 years later. So 2 years later, after H's death, his shares are transferred to Francois, a resident and citizen of France. So I don't know why he didn't give his shares to his wife. Most people give their money to their spouse when they die, but hey, who am I to judge? This is just some random person. So what's going to happen in this case? Have we blown the S election? Yeah, and we've actually blown it in 2 different ways. So first of all, we've messed up on the numbers because it's no longer husband and wife holding the shares and counting as one. So we now have 101 shareholders. So we've blown it that way. So we've messed it up in that regard. And then the other aspect is a resident and citizen of France. So even if Francois were married to wife, I don't know, it's been a couple years. Still, this would blow the S election because in that case, he's a resident and a citizen of France. Now, he can be a citizen of France and he can live domestically, and that'd be fine, because then, as a resident of the U.S., he would have to file a tax return here. But as a resident and citizen of France, Francois cannot be an S-corporation shareholder. So this blows the S election for the whole company. The whole company is now a C corporation if this happens. 5, same facts as 1 above, but W transfers her shares into trust. So what did we say about trusts before? In certain instances, trusts are a problem. In certain instances, they're not. So let's actually take a look at the requirements for trusts for a bit here. Qualifying S-corporation shareholders that are trusts, there are special rules for these. So let's go through. Trusts, only certain types of trusts may be S-corp shareholders, which include the following. One is a voting trust. Now, this isn't really a trust. A voting trust is actually a contractual agreement to vote your shares in a block together. And so that's not technically an actual trust, but it's a term that's commonly used. So you can agree with other S-corporation shareholders to vote your shares together, and that's going to be absolutely fine. So you call that placing your shares in a voting trust, but that doesn't actually change the ownership. Really, all you've done is you've obligated your shares contractually to vote with this block. And it's a contractual agreement, but it's not actually like losing your shares. So voting trusts are okay. Shareholder or beneficiaries grantor trust. Now, the idea behind a grantor trust is that it's basically like a disregarded entity. So whoever the grantor is, whoever made the trust, is going to be taxed on those items that are held in that trust. So an S-corporate share can be put into a grantor trust, and that's going to be just fine. So if most trusts these days, inter vivos trusts tend to be grantor trust. So if the trust is irrevocable, if the trust is revocable, I misspoke. If the trust is revocable, then it's going to be a grantor trust usually in most circumstances. So if you have some inter vivos revocable trust and you transfer the S-corporation shares into that trust, that doesn't blow the S election. That's permitted because all of the tax items within that trust are deemed to be disregarded from the trust perspective and flow through to the individual. And so the title can change to a grantor trust and you're fine. Now, one of the tricks about this, though, is grantor trusts a grantor trust does typically become irrevocable when a truster dies. And so in that instance, you need to make sure it still meets the other requirements for the trust. So trust to which stock is transferred pursuant to the terms of a will, which means it's a testamentary trust, but only for 2 years beginning on the date of the transfer from the estate to the trust. So this means that you've got basically a 2-year period where stock can be held in trust if you transfer it pursuant to a will. That's a specific type of trust, testamentary trust. I don't know that it's tremendously important that you understand the difference between that, but at a very basic level, a testamentary trust is created by a will. It's created when somebody dies. So these inter vivos trusts, which are grantor trusts, those would not be considered testamentary trusts. They're a different animal. And so for testamentary trusts, you've got this 2-year rule. And then you've got something called an electing small business trust, or ESBT, such as an employee stock ownership plan trust. And those are permitted to hold S stock. And then you have qualified subchapter S trusts, or QUISTs. That's a horrible name. But there's lots of interesting language here. The idea behind a qualified subchapter S trust, it's also called a look-through trust. And it essentially, the tax consequences are similar to a grantor trust, but you can have beneficiaries. And so if you have a grantor trust that's going to hold S corporation stock, you want to make sure that when it becomes, when the grantor dies or becomes incapacitated, that it qualifies as a QUIST, because then it needs to do that in order for it to be permitted as a holder. Trust owned by a beneficiary are also permitted. So S corporations as a shareholder, that's also a different type of rule that applies here. So these are the rules for trusts. Now we're going to look at whether an S corporation can be a shareholder. And generally, S corporations cannot hold S corp stock, but there is one very narrow exception. And that's a qualified subchapter S corporation subsidiary, or a QUIS. Isn't that awesome? Lots of S's. It kind of looks like a sound that somebody makes, like when they're mad or something. But that's the acronym, QSSS. That's really it. All right, so a QUIS, if you will, is the only S corporation that can hold S corp stock. What is a QUIS? Well, a QUIS is only one shareholder, which is an S corporation. So what you're talking about is the only time you can have an S corporation with an S corporation shareholder is when that S corporation shareholder is the only shareholder. In this particular instance, if a QUIS is 100% owned by another S corp and it functions like a disregarded entity for tax purposes. So basically, this two-tiered thing is just disregarded. It's kind of an odd structure. There isn't really a tax reason for setting up this type of entity structure. The only reason I can imagine why you would do this is if you have an S corporation and you're engaging in business that you think is risky and you'd like to diversify it. And so you have your S corp that's kind of like a parent corp, and then you have like a bunch of different subsidiary or QUISs. And I can think of one place I've seen this is like with a taxi cab company. So you had the big company up on top, which was an S corp, and then they had a bunch of individual S corps that own the individual cabs. And the reason they did that is if one of the cabs, like, I know this is shocking, but if one of the cabs killed somebody, they could sue that cab company, which is just a subsidiary, and take the assets and claim against that insurance, but they couldn't go after the big cab company itself. And so that's why I've seen this structure implemented. And so for state law purposes, you have all these little individual entities for every one of these little cabs that's driving around. So that is a structure that I've seen, and it's really state litigation liability concerns that cause the structure. For tax purposes, it was all disregarded, and all of the income from those individual cabs flowed through to the cab company in general. So there's your example of QUISs. They're kind of rare. You don't see them a lot. All right, so we're continuing problem 1. We've already done part A, and we just answer the same facts as above. Would W transfer shares into the trust? Well, as long as it's a grantor trust, you're going to be okay. As long as it's a look-through trust, then you're going to be fine as well. So it depends on the type of trust as to whether this violates the S election. And then lastly, same facts as above, but H and W transfer their shares into an S corporation they wholly own. Well, what happens in this case? H and W? Is this going to be a problem? So remember, when can an S corporation hold shares? Only if it's a qualified subchapter S subsidiary corporation. That's the QS, which means there can only be what? One shareholder. So think about what we're talking about in this instance. We've got a group of 100 shareholders, right? So they're transferring their shares in this S corporation with 100 shareholders into another S corporation that they own. So does this violate? Does the bottom company have only one shareholder that's an S-Corp? No, they have 100. They actually have 101, but they combine so they have 100 in this case. And so 99 of those shareholders are not an S corporation, right? You can only have one shareholder, and it has to be an S corporation. So this actually blows the S election doing this, taking this particular this approach. So you can't do that. Now, if it were the other way around, where husband and wife had a separate S corporation and they transferred it to this S corporation so that their new one was actually a subsidiary of this one, then that would be fine, because then there would be only one shareholder of that subsidiary, and it would be this entity, this especially special sandboxes company. And that would be okay, but not the other way around. It's going to violate the S election. All right, so let's look at part B. So how might an S corporation protect itself from losing its S election as a result of the transfer of shares by its shareholders to non-qualified shareholders? So we have these non-qualified shareholders. We've just seen an example where husband and wife transfer their shares into an S corporation that they both hold, and that's going to blow the S election. So what can you do to avoid that from happening? What do you guys think? How do you prevent shareholders from transferring their shares?
There's a rule, right?
Well,
Isn't there that rule where like the company has the first rights to buy back the shareholders?
Right, so you're talking about, that's perfect. So the comment was that there's a rule where companies can buy back the shares. That's a right of first refusal. And that's correct. You can agree to that contractually among the shareholders. That it's called a buy-sell shareholders agreement. And you can enter into an agreement where the company gets to buy the shares back if they're transferred in a way that violates the S election. And that's absolutely, if you have an S corporation, I think in every circumstance you should always have one of those buy-sell agreements. But at a minimum, especially if you have an S corporation with several different shareholders. Now, if it's one family that owns the S corporation, that might not be as big a problem. But even then, I still think it's best practices to always have a shareholder agreement in place. So we'll go with that. So good. Yeah, you want to have a buy-sell agreement, also called a restrictive stock agreement. There's different ways of referring to it, but it does the same thing. The idea is it gives the company the opportunity to buy the shares back from the shareholder if they try to transfer it. And I say if they try to transfer it because the transfer, if you have restrictions on transfer, they actually don't have the right to transfer it because they've contractually agreed not to. So what will happen is they will attempt to transfer it by issuing some transfer document or purchase agreement. And then by virtue of that attempt, it will not be transferred, but instead it will be transferred automatically to the corporation. The corporation will pay them out, and that'll be the end of it. So usually they'll do something along the lines of, you tend to not have favorable terms in those agreements because you don't want to give somebody the freedom to just, force the company to buy the shares back whenever they want. And so typically it's not particularly favorable terms under which you get the shares bought back. And oftentimes the corporation can pay it out over like 10 years. So that way you can't put the corporation in a cash crunch by violating this provision. The corporation will have 10 years to buy back your shares. It'll be at a discounted rate, and that's all designed to discourage people from messing up the S election. So good. The Cayman Islands has a government initiative providing significant property tax breaks and other tax credits and benefits for manufacturing facilities within its borders. Can the owners set up their manufacturing facility in the Cayman Islands? Or does that blow their S election? What do you guys think? So let's look back at the rule. What's the rule for this? You have to be what type of corporation? You need to be domestic, right? So you need to be, your corporation needs to be, what does that mean though? If you're a domestic corporation, does that mean that all of your operations are in the US? Or what does that mean specifically?
Your main operations, your headquarters.
So it means typically headquarters, but it actually means you're incorporated in the U.S. So incorporation and headquarters in the U.S. So in this case, it would depend on what we're saying. Are we saying that you're moving your headquarters and you're incorporating in the Cayman Islands? Because if you're doing that, clearly it blows the S election. But this particular example says they could move their manufacturing facilities to the Cayman Islands. But it doesn't actually say anything about headquarters. Now, you might presume that headquarters would go there. But in this case, merely having a manufacturing facility in the Cayman Islands isn't going to blow your S election. You can have activities. You can have substantial activities outside the U.S. The main thing is just that the parent company is a U.S. corporation, pays a U.S. tax return first, not as a resident of something else. So in this case, this actually wouldn't blow the S election given these facts. Now, if you moved your headquarters and you incorporated in Cayman Islands, it would. So that's the main answer there. Like I said, if you organize as a Cayman Islands entity, that would blow the S election. And also, S-Corps can hold subsidiary corporations, but both the parent and the sub must meet the S requirements. So a QSSS isn't possible here, but an LLC could own the Cayman Islands facility with a domestic S-Corp being the sole member of the LLC. So in that case, a lot of times you'll see S-Corps with partnerships as subs. And that happens sometimes. As long as everything within every entity within the S corporation meets the S corp requirements, you'd be okay. So let's go. What if they're required to organize tax? So then the follow-up question is, what if they're required to organize in a Cayman Islands company to get the tax breaks? Well, that's an instance where you might be able to set up a subsidiary, but you cannot have the entity itself be a foreign entity. You're going to lose your S status.